All right, perfect, perfect. Well, first of all, thank you all for coming out to hear this presentation tonight. Me and Antonio have been working on this for a long time and pretty much just wanted to create an environment for you all to not only just learn about taxes, but to also, once you have those tax savings, give you some tips on how you can essentially invest that money. So I'm Darion Wiggs. I'll introduce myself in a second, but wanted to at least open the floor up and give Antonio a chance to talk before we dive in.
Yeah. Thank you, Darren. Yes, as mentioned, my name's Antonio. I'm a financial advisor and a CPA. I'll be the one kind of walking through what to do with the money you have left over as a business owner and how to be mindful of taxes. So I'll let Darian start the show first, and I'll wrap up at the end there for us.
All right, perfect, perfect. Well, let's get it going then. Make sure. All right. Can y'all let me know when y'all can see my screen? Thumbs up. Should just be water. Okay, cool. All right, I see two thumbs. All right, perfect. Well, let's jump right in it. I believe y'all can see the presentation, so nothing else is needed to say. So, with that being said, again, thank you all for coming. This first section of this presentation will essentially be me kind of going over the tax component of this presentation. So, a little bit about me before you dive in. For those of you that I don't know, my name is Darion Wiggs. I'm a licensed certified public accountant, and I'm a founder and CEO of Wiggs CPA Tax and Accounting. Wiggs CPA Tax and Accounting is a business that was launched exactly 2 years ago. I guess you can round it up. We started on October 20th, 2022, but I have been a CPA for about 4 years now. And we really just have a business that specializes in working with small business owners. We do prep taxes outside of like during tax time, but we really just specialize in working with a small group of business owners, and we help take care of all your accounting needs. So we do bookkeeping, payroll, tax prep, but most importantly, tax planning. So that's what we do at Wix CPA Tax and Accounting. I do have an education in it. I know nowadays you can learn anything on the internet. So I want to point it out that me and Antonio both have a bachelor's degree and a master's degree from the University of Illinois. So we know what we're talking about. And one of the things I'm super passionate about is outside of just my 9 to 5 is I'm really passionate about teaching and just being in rooms like we are today, even though it's virtual, to essentially teach you all some of the things that I know about taxes in hopes to make your life easier, right? So let's jump right into it. So first thing I always like talking about is the downside to taxes. See, the reality is that the average American pays almost 40% of our income in taxes. Now, I know that amount seems a little bit high, but if you live in Illinois and you're making six figures, you're paying at least 24% to the IRS, you're paying at least 5% to Illinois, and then you got Social Security tax, right? When you look at those numbers of 24%, 5%, and 15, you're already above the 40% mark. And that doesn't even include property taxes, sales tax, gas tax, tobacco tax. It adds on and on and on. So when you do the math, if we're technically paying 40 to 50% of our income to taxes, well, that means that the first 4 to 6 months every single year, we're technically working for free. Now, I don't know about y'all, but I don't like working for free. I've done it before, but if you think about it over a lifetime, taxes is one of our largest expenses, and there's kind of no way to avoid it because growing up, we're not really taught about it. So I'm glad you all here because I want to teach you about some of the rules that help you avoid it. But I just wanted to point that out that yes, taxes can be bad, but it's also some upside to it. Now, taxes, as we always talk about, right, is 70,000 plus pages when you look at the tax code. Now, it's a lot. It can be very overwhelming, right? But the goal of this is to, when you think about the tax code, it's not teaching you how to pay taxes. If you do your research and work with a qualified tax professional, we can educate you and teach you that the tax code is essentially a rule book teaching you how to legally avoid taxes. You see, the wealthiest people around the world don't pay taxes because they understand this, right? Yes, taxes can be the big bad wolf, but if you understand the rules, then you can essentially get on the winning team. And now you're going to be in a position to save thousands and thousands and dollars of taxes over time. So that's kind of like some of the main things about taxes. It can be overwhelming, right? But it's also created for those who know the rules. So here's all the rules. I'm going to break this down as simple as possible in my spiel, right? Rule number one, y'all, is that we need to get on a winning team. See, at the end of the day, tax code wasn't made for W-2 employees. I didn't make the rules. And it's not saying nothing is wrong with having a W-2, but it's just the reality of it, right? And the way I always put it, right? I don't know if y'all can see this $20 bill in my hand, right? And the best way I can demonstrate it is that if you're a W-2 employee, and it's going to break my little heart, is that you make $20, the IRS takes their money, and then you get to spend what's left. And what happens is you make $20 a W-2 employee, And when it's all said and done, you get your check, you got like $13. Like you don't have everything that you signed up. That six-figure salary, that 80,000 salary. The reality is you don't get that because when you're a W-2 employee, you make money, IRS takes money, and then you get to spend what's left. Now, for my business owners, you got to realize that the tax code essentially was made for anybody who's a business owner or an investor. Why? The government is lazy. That's the way I come to it. The reason why is because they think about it this way. If Antonio has a job, right? If he has a business, that means he's creating jobs, right? If Kelly owns rental properties and she invests, now she's creating homes and the government doesn't have to do it. So what they're going to do is they're going to incentivize us to act certain ways by giving us these tax deductions. That's why a bunch of the wealthiest people invest in real estate. They got a business because the tax code at the end of the day is made to essentially benefit us. And the reason why is because business owner, you make the same $20, but that's the one that's ripped. The IRS already took that money. You make the same $20. This one isn't ripped yet, right? But the IRS is like, cool, Darion, you made $20, but because you're a business owner, before we rip it, you get to spend your money on anything that's ordinary and necessary to operate your business. And if you do it the right way, there won't be any money left for you to pay taxes on. So once you start shifting your mindset and understand that as a business owner, you're in a good position because if you understand the tax code and you really take some time to proactively plan for taxes throughout the year and understand that you don't get tax paid, you don't have to pay taxes on what you bring in the door. You pay taxes on what's left after all your ordinary and necessary expenses to operate your business, which are write-offs. So what is a write-off? Rule number 2. So rule number 1 is got to be on a winning team. And from my introduction question, it seems like a lot of us are on a winning team. Now, the second rule is we need to understand the rules. And the rule number 1 that everybody needs to know out of the entire tax code is that we need to understand code section 162A. And you're going to hear me say this for the rest of my life, is that the IRS basically says that if you have a business or you invest, right? If it's ordinary and necessary to operate your business, then you can write it off on your tax return. And I'm asking the chat, who gets to determine if it's ordinary and necessary to operate your business? Is it your mom? Is it your dad? Is it your business partner? Is it Uncle Sam? Like anybody want to take a guess? Anybody. When you do the math and you think about it, the IRS isn't in your back pocket every day. Oh, that's ordinary. That's no. You as the business owner, you get to decide what's ordinary and necessary to operate your business, right? That's not me saying go buy a private jet or buy a boat just because. This is me just reminding you all that you don't pay taxes on what you bring in the door. You need to understand write-offs because write-offs essentially reduce your taxable income. So if you made $100,000, but you got $40,000 in expenses, you pay taxes on what's left. So that's what the 2 rules are, right? You need to understand that in order to win the taxes, you need to be on the winning team. And the second part is you need to understand what a write-off is. So before I go into my kind of big demonstration and everything, I just want to kind of point these out that these are some of the common business deductions that most business owners qualify for. And I'm one of those CPAs where I'm not going to tell you, oh, just go spend money for a write-off. I'm one of those CPAs that just want to highlight that a lot of your personal expenses automatically become deductible the moment you have a business. You see, you get to write off your meals, you get to hire your family, your friends, write that off. You're going to eat anyway, right? Health insurance, accounting fees, right? A lot of us work with product-based businesses. We got to ship things, your internet, your cell phone, website, everything, LLC fees, any expense that you have. And I'll go more into this list in a second. Any expense that you could say, hey, the only reason why I spent this money was because I wanted to reduce my taxable income. We need to keep that in mind in order we could deduct that. So that's my spill on that. I did want to give you all a quick little example. I'm like more of a visual learner. I don't know, is any visual learners in here too as well? I know. Okay, cool. So I know a lot of times we get to these presentations and it's really just kind of just listening the whole time. So I like to kind of draw it out. So I'm gonna pull out my whiteboard here really quickly and y'all can let me know when y'all can see my screen. And can somebody see? Can I see the whiteboard? We all good? All right, full disclosure, I'm an accountant. My handwriting is not the best. However, so this is what I do on my day-to-day, essentially to help my clients reduce their tax bill. And when I saw this, it kind of made sense to me. And it's something I implement with myself every single day. So like I mentioned at Wiggs CPA Tax and Accounting, we specialize in working with business owners who provide a service. Our logic is you provide a service to others, let us provide a service to you so you can free up more time. Stress less about the accounting part of your business. You focus on scaling and growing, sales and production. We'll do the accounting for you. So I work with a lot of business consultants And one person I wanted to introduce you all to is Kevin. So Kevin is an environmental consultant that we work with, right? And he's here in Illinois. So in this case, Kevin makes $100,000. I don't know about y'all, that's good money, right? $100,000. But the problem is, and what I said in the intro, is that if you make $100,000, especially here in Illinois, all that money isn't yours because you got to pay 30, at least 30% of that is going to taxes, right? And simple math, y'all, that's a $30,000 tax bill. And I don't know about y'all, that's a lot of money. I see it all the time, but that's a lot of money. $30,000. However, like I said, no to winning taxes. Rule number one is that you need to be on the winning team. And rule number two is you need to understand what a write-off is. Now, as mentioned, Kevin is a consultant. So he don't pay taxes on that 100,000. He pay taxes on what's left after his expenses. But a lot of times people skip over that part. So when I work with guys like Kevin, first thing I do is let's talk about your expenses. And what you realize sometimes is a lot of times, like I mentioned, you need your phone to be available, right? You're a business owner. You need to be in contact with your clients. You need to eat. You need your internet. You need Zoom subscriptions. You need laptops. You need business conferences. You got travel expenses. There's a lot of expenses that goes into it. So Kevin, all scratch, when we worked with him, he had about $10,000 in just regular, just business expenses. Just those day-to-day expenses that everybody has, and now he's able to deduct that. So once we look at that, another deduction that a lot of business owners qualify for and we unaware of, has anybody heard of the QBI deduction? Has anybody heard of that? Okay, Antonio, can't see everybody, but I'm hoping in the chat that somebody has heard of it. And what a lot of people don't realize is that the QBI deduction, the IRS gives you a 20% deduction based on your business income to offset your taxable income. So in this case, if Kevin made $100,000, well, he gets a $20,000 deduction, but a qualified business income deduction just because he has a business. Now, W-2 employees not be getting that QBI deduction. And business owners, we luckily get it because when the tax code changed a couple of years ago, they reduced the corporate tax rate to 21%. But that's for corporations. What about my business? What about your business? Well, that's when the IRS and the government decided to give small business owners, right, as long as you qualify, an automatic QBI deduction of 20% of your income. So if you qualify, that's an automatic deduction. So now my boy Kevin here already got about $30,000 in deductions. On top of that, a lot of times when we become business owners, we have to invest in ourselves. See, if you're someone like me, when you first start a business, sometimes you don't know what you're doing, right? Marketing, sales, the technical work. You need a mentor, you need a coach, you need to take that real estate course, and all of that adds up. So in Kevin's case, he spent a lot of money on education. He spent about $10,000. Wait, time out. Brain fart. Is education expenses even deductible, y'all? Like, anybody, is it, Tonio, is it
Yes,
deductible?
I
Because
did.
I always, when I think about this, I battle going back and forth because Antonio and I, and a lot of people in here spent over $100,000 to go to University of Illinois to pay for our education, right? We couldn't write off a single penny on our tax return. None of y'all can, right? You go to an accredited university, you can write off interest on your student loans of $2,500 if you make less than 85K. But the average American, especially if you only have a W-2, you can't write off a single dollar in education. But what if I tell you as a business owner, different rules, y'all. You see, as a business owner, the IRS is like, okay, you can invest in becoming a better business owner. You can pay Tony Robbins, Grant Cardone, Bill Gates, Patrick, the Value Entertainment guy, like anybody that's doing exactly what you want to do so you can speed up the process and learn directly from the horse's mouth. You can pay them thousands and thousands of dollars. And because you are a business owner, investing in your brand and your business and becoming a better CEO, now education expenses are deductible. And me personally, in my first year as a business owner, I spent north of 20K. So 10K. And y'all, I don't know if y'all signed up for some of these coaching programs, but these things are mighty expensive. But I just want to keep that in mind, let you all know that education expenses is deductible, but you have to invest in the right education. So on top of that, another way that Kevin is able to reduce his taxable income, and you all can too, is that we get to write off a portion of our rent and mortgage, right? See, the IRS gives you two ways to write off the home office. They say if you have a place within your home that's regularly and exclusively used for business purposes, well, now you get to deduct that on your tax return. See, if you got a W-2, You're not being able to write off your rent, your mortgage interest, and property taxes. IRS, all right, you got two options. You get $5 per square footage. So if you're in your living room or you got a home office or you got the basement, well, take the square footage, you get an automatic deduction, $5 per square foot. Or if you get smart on them, like, all right, I got a 2-bedroom apartment. I'm going to make my master bedroom my home office since it's bigger, and it accounts for about 25% of my home. Now, since you took that route, now 20% of your rent, your utilities, that's gas, water, repairs. If you own your mortgage, interest, property taxes, now you're able to deduct 25% of your home office related expenses on your tax return. So in Kevin's case, he got an automatic deduction of about $12,000 just because he had a business. On top of that, if you got a business and you work from home, well, anytime you leave home for the most part, it's considered going somewhere for business purposes if you plan it out the right way. IRS, same thing with auto. They're like, hey, you either get 67 cents per mile, or the IRS is like, if you use your car for more than 50% business purposes, you can detect that percentage usage for your car. Let's say you're using your car for 80% business. Now you get an 80% deduction for the interest on the loan, the tires, the repairs, the car wash, the parking, any cost associated with your car, you're able to deduct that too as a business owner, and it can essentially be used to offset your taxable income. And the beautiful thing about the auto deduction is that the IRS understands that the moment you leave the lot with that car, we all know that it loses value right away, right? And because of that, the IRS is like, cool, we're going to let you depreciate the value of this car over a 5-year period. So it don't matter how much your car weighs, you can get up to a $20,000 deduction in year one, up to a $20,000 in year one, just because the IRS will allow you to depreciate your car. And for those who don't know, it just pretty much, it don't matter how much you put as a down payment. Your car can be $60K and you use it 100% for business purposes, right? At the bare minimum, you can write off up to 20K in that first year. So just keep that in mind. So my friend Kevin here, believe he had about $25,000 in auto expenses that he was paying for anyway. But since he has a business, those things are deductible. And my last one I kind of want to point out really quickly is my favorite one and one that get missed a lot. See, a lot of times when we shift from corporate America or we shift from just having a job into running our business, during that process of transitioning, a lot of us are nervous at times because we lose out on those health benefits, those retirement accounts, like those fringe benefits, those perks that you normally get. But when you have a business, I just want to remind you all that you can set up a solo 401k. You can set up your own retirement account with Antonio and somebody that knows what they're doing, and you can get the same deductions. See, if you're a business owner, the IRS would allow you to deduct $23,000 towards a solo 401k. And what makes this deduction beautiful is that not only is this $23,000 being used to offset your taxable income, but you're also able to put a lot more money towards your retirement. And you get to build wealth a lot faster. And to make it even better, the max that you can contribute, because when you're a business owner, you're the employee and the employer within your business. So I said 23,000, but you can actually contribute up to $69,000 towards this solo 401k. And that's one of the easiest ways to offset your taxable income. So let's just do the math here, right? We got $10,000 in business expenses, 20, 10, 12, 25. Look at God. Well, when it's all said and done, y'all, this is about $100,000 in expenses. And remember what I say, y'all, as a business owner, you don't pay taxes on what you bring in the door. You pay taxes on what's left after all your ordinary necessary expenses to operate your business. So if you made $100K and you spent $100K, well, now when you get your tax return, you're showing $0. And guess what? Now your tax bill is $0. Literally just wiped out the tax bill. And the beautiful thing about this is I didn't tell y'all to do anything fancy. I literally just said, hey, you got a phone, you got your laptop, you got your subscriptions, right? You automatically get the QBI deduction if you do it the right way. You're going to invest in your education. You need somewhere to live, so you got to pay for rent. Most of us got a car, so you got to drive around. And you also at this presentation, so it shows that you want to invest at some point. So you set up a solo 401k, nothing out of the ordinary. But if you do this the right way and we proactively plan for taxes throughout the year, you'll be in a position to make this happen. You see, a lot of times what we do is we fail to realize, and it's not nobody's fault, that there's two different tax seasons. There's tax prep season, That's when you come to your accountant in a few weeks, right? Or a couple weeks in January, February, and you give me all your 1099s, your W-2s, and you're gonna give it to me and be like, hey, thank you. And I'm gonna tell you what you owe, right? But a lot of times people come to me in 2025 saying, hey, how can I reduce my 2024 tax bill? And I'm gonna tell you the year is already over. It makes it very difficult to implement some of these strategies if the only time we're worried about taxes is during tax prep season. So this is just a quick reminder before I transition to Antonio, is that we need to realize the importance of tax planning. If you have a business, we need to stop waiting until January and start doing this proactively throughout the year, right? The biggest tax we all pay is the tax of not knowing. So hopefully this kind of gives you a little bit of insight on some different strategies you can use. And if you got any questions, save them to the end. But now that you just saved $30,000, Antonio is going to take this time to teach you how to invest it so that you can build generational wealth. So I'll let you take it from here, Antonio.
Thank you, Darren. That was awesome. I just wanted to give 2 minutes here as a breather here, guys. Guys, what's one takeaway you learned from Darion today before I just move on to my presentation? I want to hear your takeaways, guys. Either shout it out, put it in the chat.
The QBI is something new for me. So I think that was very useful to know. And then the solo 401k, and then yeah, basically like the deductions and how he wrote everything out was very helpful.
There you
Good,
go.
good. And let us know if you have questions or need clarification on that at the end. We can definitely walk you through it.
Yeah.
I'll definitely say too, I love the part about, being able to use part of your house as for a business purpose and being able to know that like per square footage you can, save on your rent expenses. Like that was something I did not know. So thank you for that.
Yep, no problem, no problem.
Yes.
All right. Well, yeah, Tony, I guess you can kind of take it from here. Mario, I guess, Tony, while you're sharing your screen, very applicable to real estate. It just depends on if it's a long-term rental, a fix and
Yep.
flip, or, the different strategy because it's passive versus active. I can break that down. But all of this is applicable to real estate investors too. There's just phase outs when it comes down to having long-term rentals. But I can walk you through that part.
Cool. And Darren, one question for you. If I'm a business owner, I'm seeing that it's more important to do tax prep than actually just doing my returns. When's the best time to reach out to you about prepping? Is that in January? Is this in June? When's the best time to hit you up to do prepping for you?
Yeah, if it's strictly just, hey, here's my W-2, my 1099s, tax prep season starts around January. So after January 30th, the IRS starts accepting returns and we can point you in the right direction. But I can tell you now, if you're experiencing way more income than you did in the last year, you definitely want to reach out within the next few weeks so you can at least have the last 2 months to proactively reduce that bill.
Okay, perfect.
Mhm.
Thank you, Darren. Well, I'm going to share my screen. Again, as mentioned, I'll be walking through once you save the money from taxes, what you can do with the extra money as well, right? Because again, you can definitely keep this money, but it's important to reinvest back into your business or use the different streams of income to help your business grow even faster as well. So I'm going to share my screen with you guys. Let me know if you guys see my screen here.
Yep.
Just thumbs up. Okay, so I'll be focused on investment strategies and tax hacks here. So before I just start there, I want to introduce myself as well. As mentioned, I'm an advisor. I've been doing this for the last 4 years and a half now. I also went to U of I, also CP as well. I got to work as a financial advisor because I worked for an accounting firm for about a year, but after I realized my dad passed away, not having a trust, not having a will, we had to pay over $45,000 of probate court fees. I'm like, wait a minute, if I don't know about this, like, what else am I that I don't know about money? Because in reality, you go to school, they teach you to get a job, get cash, and retire someday, hopefully. But that's all you know about money. And I realized, you know what, there's more to it. And that's why I became a financial advisor to educate people. So here on my team, we have my beautiful wife, that's my director of operations, Kenya. You have Luke, my investment associate, and recently my little brother, who just became my intern this summer. So this is my team here. What I do as a financial advisor, the best way to think about it, I'm like an architect, right? People tell me how they want to build their home, and I give them designs how to go about it in the most efficient way when it comes to finances. Now, what I'm going to show you guys is more of a rule of thumb. This is not to give you advice personally. Not if you want individual advice, I'll be more than happy to sit down with you. Okay, same thing with Daryl. When he's showing you, it's kind of like broad, but now if you want individual tax planning, you'll definitely want to consult one-on-one with that. So I just wanted to show you the fundamentals of talking to a financial advisor. A lot of my clients are business owners, and I explain to them their biggest rate of return is their business. Because if they spend money on marketing, on employees, inventory, they'll get 20 to 30% profit margin. But they also realize, hey, I want to step back one day and I don't want to work for the rest of my life because if I don't sell this business or I don't sell the business to someone else, I can't retire one day. So for that reason, it's helpful to understand what are clients' goals, and then we can help them understand what's the right tool for that. For example, you have short-term goals, mid-term goals, long-term goals, and ultimately retirement. So short-term, that's call it about a year to 2 years from now. So this can be, you know what, Antonio, I want to hire new employees in the next 6 months. Or, you know what, Antonio, I want to buy a new rental property. I want to buy new equipment. I want to buy this new inventory and cost me this much money. And if it's between a year to 2 years, the best thing you're going to use, it might be a high yield savings account, a money market account, or a CD. Why? Those accounts will give you anywhere between 4 to about 5%. Here's just an example, right? If you use a saving account like Ally, you notice they'll pay you about 4.2 of interest compared to your regular bank account like Bank of America, which I use and Chase myself, they're only going to pay you 0.0% of interest, right? So for example, let's say you want to save $10,000 for new equipment the next year as a business owner. You could keep $10,000 for your Chase savings account and earn 1 penny, or you can earn 420 bucks using a savings account like Ally or different banks that offer the same things as well. So again, it's important to let your money grow for you, not you working hard for your business. Okay. So again, this is an example. If it's short term, it's best to use a high yield account, money market account, or CD. And again, there's more examples, but I want to show you an example of that. Now you might say, Antonio, what if my goal is to buy more rental properties, buy equipment, or even buy a new equipment, a new store in the future? Because oftentimes when business owners become big, they do merger and acquisitions. That means they're one company, but they want to expand and they want to buy a new company, and it's called merger and acquisition. So in order to do that, we need to have capitalized. So we need to either take a loan out, save money, or invest this money to buy this new business you want to buy. So an example, let's say the next 16 years, hey, Antonio, I got to save 200K the next 16 years. What does that mean? So let's say we invest your money. And again, it's important to talk to a financial advisor to understand your risk tolerance, if you're aggressive or you're safe. But let's say you put 500 bucks per month away, which is $6,000 a year. You do 500 bucks per month between now and the next 16 years. That means at the time of your next 16 years, you would have saved over $200,000. Out of your own personal savings, you save about $96,000, but it grew to over $117,000 of just worth of interest. So you pretty much double your money in about less than 15 years now. And you might say, Antonio, this is awesome. This is money I can use before retirement because I understand my Roth IRA, my 401k, my SEP IRA, pension. I have to wait until at least I'm 60 years old. With investment accounts, there is no penalty. You can take money out before retirement. Now, your question might say, what about taxes? If I gain over $117,000, what does it mean with taxes? Well, you have a thing called capital gains, which Darren can help you more as well. But with capital gains, that's how you get taxed based on you sell a rental property, an investment account, something that's appreciated in value. So let's say, you make over, $492,000 on investments or your W-2 income. Your tax rate, believe it or not, is only 15%, right? So let's say you do make $100,000 of profit after 15%, you keep $80,000 of the $100,000 you made after taxes as an example, right? Which is actually less than most people think, because if you make 400K as a W-2, you're going to pay north of 37% of tax bracket at that point. That's why it's important to consult with a financial advisor and a CPA so we can help you understand what's the right tax deduction for you as well. So now that we understand how to put money for your short-term and long-term needs, you might say, Antonio, what if I want to be able to pass on wealth or sell my business one day or expand in the future as well? So a lot of business owners and a lot of the wealthy people they use life insurance as a way to pass on wealth and avoid state taxes. So Darren talked about federal and state income taxes, which is something you pay while you're still working right now. But in certain states, depending on how much you make in your state, a state means your balance sheet, like your house, your business, whatever it is. If you have us over $13 million, anything over $13 million, you pay estate taxes. So a lot of the wealthy people say, hey, instead of me paying the government state taxes, I'd rather pass on wealth to other individuals like my business or my employees or my family. So, and you can do your research on your own, right? You look up life insurance owned by banks. You look at the top banks here, like Bank of America, Wells Fargo, JP Morgan, PNC, BMO, all those different banks you've noticed as of March of 2024. The biggest bank, like Bank of America, they own about $24 billion in life insurance. And I'm scratching my head. Why would banks own that much money in life insurance? Well, how do banks make money? They make money by using your money that you put in your bank. They borrow that money from yourself. They invest that money, and in return, they give you back, using money for that in place there. So, for example, let's say I deposit money into Chase. The Chase I have in my Chase account, they'll lend the money back to Darion and charge him 7 to 8%, whatever it is, to buy a home, right? So they use your money to invest money. So this is how banks use it. This is in billions. Again, life insurance is not for everybody, but here's an example of how it works. You can rent it or you can own life insurance. If you rent it, think like renting an apartment. Very affordable, it's cheap in the beginning, but in the long run, it gets more expensive, and at some point, it expires whatever you put inside of it. So let's say your policy ends at 80 years old. After 80 years old, your policy is done. Kind of like a lease in an apartment. You don't get your money back at that point. Or you can own your life insurance called permanent, which you're going to pay more upfront. Like when you buy a home, you have down payment costs, closing costs, appraisal costs. You have all these extra costs compared to an apartment. But in the long run, once you do have a house, you can sell it, you can borrow against your house, you have equity inside your house as well. So the same way people use real estate to build wealth, a lot of people and business owners can use life insurance as a way to build wealth. So here's an example, where I have this individual in their 20s putting about $2,000 per month by the time they're 44 years old. So by the time this individual is 50 years old, they will have about $800,000 they have available to withdraw, even though they only put $408,000 at the time they retire 44 years old. And if you notice, at the age of 50 years old, there's a negative $100,000. That means that person can actually withdraw money out from the life insurance policy as a loan to themselves. And they don't have to pay money in taxes because in reality, they're borrowing against themselves. And so you see the negative $100,000, that just means the money is being deducted, and the money deducted you use for yourself will reduce your death benefit. Death benefit means if you pass away, how much your family gets. So as you take money out from your policy, that reduces what your family will inherit. Okay. So lastly, I want to talk about retirement because Darren talked about a 401k, solo 401ks, and how to reduce taxes. And it's helpful to understand talking to a financial advisor CPA to help you understand what's the right tool for you. For example, if you're a big business owner and you're making some good money, at that point, we're going to have to help you understand, one, do you want to give option to your employees? Let's say you have employees, you have 10 employees. You say, Antonio, every time I hire somebody, someone else takes my employees because they offer benefits and I don't offer that benefit because I only have a solo 401k. Well, at that point, we might discuss about doing a 401k, simple rate, or SEPA rate because those accounts allow you to match for your employees and still get a deduction. So, for example, if I have a 401k for my business and my employees put money in, if they put money in and I give them a match, it's a write-off deduction for me as a business owner, right? But with that as well, you're incentivizing your employees to be with you long-term because you're offering them benefits as well. Let's say you just started your business recently and you're not making as much as you thought. You can still do individual retirement accounts like a traditional rate or Roth IRA. So here's what I mean by that. So, when it comes to like Roth IRAs and traditional IRAs, the max you can do is roughly about $7,000. But once you start making more income, Antonio, I got a big tax bill I got to worry about. Well, we can talk about with Darion, hey, we can deduct up to $69,000 from your taxable income using as an example, a SEPA rate as an example. Or, hey, Antonio, I'm not making as much, but I do want to deduct up to $23,000 from our 401k. We can do that as well, right? So if you notice, there's different ways you can put money in as a business owner to get a deduction for your retirement, but as well to help understand the benefits for you and your employees as well. Okay. So for example, I'll give you a real life example of a client. I had a client who just started a business with just one person. So we did a simple Roth IRA for him because he was not making much. And then he exploded. Now he has 20 employees. Like, Antonio, I got to offer my employees some offers. So now we're doing a 401k for him and his employees for him to get a deduction and for his employees to get a deduction as well. And you might have heard the word traditional Roth IRA a couple of times today, but let me kind of walk you through the difference. A traditional IRA or traditional 401k allows you to get deduction today. So Darion, he loves this because when he talks to you, he understands that whatever you put in can help you reduce your taxes at that point. That's why a lot of CPAs enjoy this benefit. But in the long run, once you retire and you take this money out upon retirement, you will be responsible to pay taxes at that point. So there's a good and the bad thing about traditional IRAs. Same thing goes on with Roth IRAs. A lot of people hear about Roth IRAs, but people don't like it because in the beginning, you don't get a deduction. So going back to Jimmy's example, if he makes $100,000 and he puts $7,000 in his Roth IRA, that $7,000 is not deductible. You can't reduce it for taxes right now. But when he retires, that money will go with component of interest, and all the money he takes out will be completely tax-free. So here's a cheat code you can tell, maybe your young nephews, your young nieces or brothers. A good trick that I tell people, especially when they're in college or in high school, if you have a Roth IRA open for more than 5 years, you can put money in, and if you buy your home for the first time, you can take up to $10,000 out from your Roth IRA with no penalties and taxes for your first-time home purchase, right? Or, hey, I'm still in school. I'm going back to law school, back to my master's program. I need some extra cash for school. You can take money out from your Roth IRA to also pay for qualified education expenses as well. So there's nuances with each account. It's what's helpful to understand. Consult with a financial advisor one-on-one on what's the right tool for you, basically. So one thing I was going to show, because again, I am a financial advisor, but I'm also a CPA as well. It's helpful to understand that taxes, anything you do is based on taxes and what you do. So I'll give an example. This week recently, I had a business owner. Usually he makes roughly about 200K. So his taxes is roughly about 32%. But this year, his business has been slowing down, and he made about $100,000. So now his tax bracket as a single individual went from 32% to 22%, basically. So his tax deduction went down 10% at that point. But one thing we realized is he had an old 401k from his previous jobs. So what did we do? We took his old 401k and converted to a Roth IRA this year to take advantage that he's at a lower tax bracket in order to pay taxes now versus him delaying this tax later on in the future. Okay. So the last thing I will show when it comes to saving for the future in general is everyone loves discounts on shoes, clothes. You buy one, get one free, 20% discount. We all love it when we see discounts. But if you think about it, no one thinks about getting a discount on your own future. For example, if you want to have $1 million by the time you're 65 years old, someone who's 25 years old will have to put $380 per month. Now, someone who's 35 will have to put over $820 per month. And if you're over 45 years old, you have to save over $1,920 per month. And don't get me started at 55 years old. Just imagine yourself, you have to save over $5,000 just to reach the same goal. So what I'm trying to say here, guys, is the younger you start doing this stuff, the more you'll be better off financially off. Because a lot of people say, well, that's for you when I'm older, more established, but you can be as 13 years old, for example, and Derek can walk you through this. If you have a business and you have your niece, your cousin, your someone who's still young, but you can put them on your payroll, they have earned income, and you can open a Roth IRA for them at a young age and put money away towards the future as well. And at the end, it's helpful to understand there's no one size fits all. It's important to understand when you're a business owner or individual, we want to have multiple streams of income, right? You want to have your Social Security come in, your Roth IRA, your 401k, an investment account, your business, you might have a pension, life insurance. So you want to have multiple streams of income because people are going to be happier they have options versus most Americans who don't know what's going on. You look at stats, people who only live out Social Security, about 60% of them live paycheck to paycheck because they understood that Social Security is not enough to retire. It's a way to retire, but it's not the way to retire as well. So that's my slides here, guys. My value add is helping clients build wealth. But going back to a GPS analogy, a GPS will tell you how to get there and how to avoid time of you doing your own research. That's what I do as a financial advisor. We sit down with clients, understand what are the goals and their needs, and help understand what they should be doing based on your specific goals. Or a lot of people, what they do is they hear stuff on TikTok, on Google, on YouTube, and sometimes they get overwhelmed with so much information and don't even know what's applicable to them. That is why it's important to sit down with a CPA for tax prep and you're doing your taxes. But with that as well, talk to a financial advisor, help you understand how to let your money grow for you versus you working hard for your money. So with that being said, I'm gonna stop sharing my screens here and I'm gonna open the doors and questions for anything you have, and we'll go from there, guys.
Yeah, that was great, Tonio. Appreciate you sharing everything. I guess if anybody got questions, you can come off mute and kind of say them. If not, I
I have a
did get a
question.
couple. Okay, perfect.
Yeah, sorry.
I'll take your time.
All right. So in the Kevin example you provided, is that Kevin the person or Kevin the business? Because in that example, I didn't see where is his income, where he can use it for his personal use. Like
Gotcha.
how do we deal with where's that portion of it? Because all the expenses were all business expenses, so he's left with zero, so his
hmm
tax is zero. But where is his personal income?
Exactly. Great question. So yeah, with Kevin,
So,
yeah, yeah.
sorry, which kind of leads to my other question, which is how would I pay myself as a
Mhm.
business owner?
Okay,
There you
gotcha.
go.
I guess the get it for Kevin. So great question, by the way. So that $100,000 is technically Kevin's income, right? He made $100,000 for the year. The whole point of the example is just showing that put heavy emphasis on the fact that you can keep the money and you can pay taxes on it and you can use that money for personal expenses, your lifestyle, etc. But with the example, I was just trying to highlight that a lot of those expenses, the phone, the internet, the rent, the education, it's stuff that you're going to pay for already. But the perks of being a business owner is that you get to reduce your taxable income versus W-2 employee, you make $100,000. Like you're gonna have a way smaller pot to spend on your personal everyday expenses versus Kevin. He kind of gets a discount instead because not only is he like paying for rent, his meals, and those expenses I mentioned, but he also doesn't have to pay in taxes. So he doesn't have a lot of money necessarily left over to do his take trips and do all this fancy stuff. But that's one tricky thing with taxes. And one thing I always ask when anybody come to me to file their taxes, I ask, what's the goal here? Do you want to pay $0 in taxes? Or do you need to show income on your tax return so you can qualify for a rental property? Because a lot of times everybody want to live this tax-free lifestyle and they realize that, okay, it's nice not paying taxes at all, but when it's time to apply for a mortgage or a business loan, et cetera, you need to show income in your business so you won't take those deductions. So hopefully that kind of like answers in the terms of the thought process I have for that one. And does that answer before I go to the paying yourself part?
Yeah, it does.
Okay.
Because the last thing you mentioned is the same thing issue I had.
Mm-hmm.
I was able to reduce my income significantly, but then I don't qualify for loans.
Exactly. Yeah, the way I put it is sometimes you got to pay to play, you know? The IRS, the banks, the lenders, they look at the average of your last few years of tax returns. So make sure when you file your taxes next year, you speak with your preparer or whoever's doing your taxes and let them know, hey, they should be asking, first of all, what's your goal? But keep that in mind for you because at the end of the day, it's your responsibility, knowing that, hey, I need to show some income. And if that is the case, you do have to pay taxes. But then that's when you save for taxes throughout the year. So when you file your taxes in April, it's not a surprise. You already been saving for taxes proactively throughout the year. So that's the way around that. Now, as far as paying yourself, that one gets a little tricky depending on what type of entity structure you have set up. For instance, if you have a single member LLC and it's just you owned it by yourself, you don't have to run payroll necessarily because you're going to get taxed on the net income of your business no matter what. And when it's time to make money, you just transfer money from your business account to your personal account and you spend it that way. That's if you're a single member LLC. But if you got like a corporation, right, or S corp, then your requirement, you get tax savings with those entities sometimes. But what happens is you have to pay yourself a reasonable salary. So if anybody here has an S corp, yes, it's helping you not pay self-employment tax. It's going to reduce your tax bill by 10 to 12%. But if you have an S corp, you have to pay yourself a reasonable salary via Gusto or ADP and pay yourself like an employee within your business. Does that answer?
Yes.
Okay, cool, cool. Any more questions? And to buy some time too, it is two or three people here who ask questions in advance that I do want to kind of get those answered because they are here. So Antonio, the first one is for you. I can help answer it, but I wanted him to
Yeah.
get your perspective on it. So Kareem asks, if you have a 401k from a previous job, and should you put that money in your solo 401k so that you can invest in his real estate business? I know Kareem, if you want, he's at the gym most likely, but if you can
Okay.
answer that for the public, that'd be perfect.
Yes. So when it comes to your old 401k, in reality, you have four options. Your first option, you can cash it out if you want to, but don't advise that you have to pay a 10% penalty fee and pay taxes.
Mhm,
Your second option, you can leave it as it is. The only problem is you can't put money inside of it and you can't really control the investments. It's just kind of something that's done at that point.
mhm.
Third, you can put it inside your solo 401k as you mentioned, or your new 401k set up there and just switch things around at that point. Just it's like going from like Chase to Bank of America. You're not paying money in taxes, just switching money over basically. Or as an example I showed earlier, you might be a lower tax bracket this year or next year, and you might consider doing a Roth conversion where you take an old 401k and put it in Roth IRA to take advantage of the new tax cut you have now. And that way the money grows tax-free upon retirement as well. And again, based on your tax income, it'll be helpful to sit down with me and Darren to help understand, are we the 24% tax bracket, 32% tax bracket to understand if Roth conversions make sense, or just keep it in your solo 401k at that point.
Got you. He probably is not here. I can clear it up if he needs more questions on it. But no, I appreciate that perspective on it. And I know Kelly, you had a question. It was if I get a hold of a few $1,000s to invest, how should I invest that money to receive passive monthly return on a few $100s? So I already know the answer, but Antonio, you can kind of tell her some advice. It'll be hard, but to kind of tailor it for your
Yes.
unique situation, but he got you.
Yes. I would say the best rate of return, Kelly, will be your business. Let's say you really want to expand your business into like marketing, advertisement, because hey, if I spend $1,000 on emails, calling people, you're gonna make your money back for sure, right? So I would say always reinvest into your business. Once you have enough income, you have left over, Anthony, I got a couple $1,000s per month that I can save. Now, at that point, it's going to be helpful to talk to a financial advisor, help you understand what are your goals and help you understand, do we use this tool, or that tool based on the goals you want to accomplish, Kelly.
Mhm.
Okay, thank you.
Mhm.
Yep, yep. And then Mario, I saw you ask the question about phase outs. I can't see the chat box. Does anybody else don't understand phase outs when it comes out to taxes? Okay, cool, cool. And I'm gonna try to break this down. So when you hear about taxes, I mean, and this is me just keeping it real with you all, there's a lot of different deductions and route you can take, right? You can do the Roth IRA, you can write off cars, you can get deductions for paying your it's a bunch of different deductions, but there's phase outs, meaning once your income is above a certain threshold, you may not qualify. for example, have y'all heard of the electric vehicle tax credit where it's like if you buy a car that's if you buy an electric vehicle, then you can get up to a $7,500 credit. Sounds good. You'll hear that on the internet. Well, I'll say it now. It's like, oh, I'm about to get a Tesla. But the truth is, the phase outs is like one, if the car is above a certain price, you can't get it. Well, you can buy it, but you don't get the tax credit. And the income phase outs is what I normally typically point out is that the IRS is like, hey, you can get this $7,500 credit, but if you single and your income is above $150,000, well, you don't need the credit because you got enough money technically to buy this car without us giving you a credit. So just keep that in mind. Anytime you hear me say anything, even with the QBI deduction or just anything that we say, there are phase outs. Even with the Roth, once you make more than what's the number, Antonio? Like 140, 180, what is it? Changes every year.
162.
Yep, there you go, right in the middle. So once you get to that middle mark, you reach it, you can no longer directly contribute to a Roth. So now you got to do a backdoor, which is a whole talk conversation by itself. So just keep that in mind. Tax deductions is cool, but just make sure that's why we're here. And you need to work with a qualified tax professional, CPA, so we can explain those phase outs to you because you may not qualify for everything we just said. Does that help, Mario? I'm gonna assume yes, but
Yes, thank you very much.
okay, perfect. Yeah. I saw that question. Let me know if I need to clear anything up. Did we miss anything else in the chat? Does anybody else have more questions?
Kimberly asked if this will be sure to watch later.
Yes, it will be shared. I'll send out an email to everybody who signed up within the next 24 hours, and then you can kind of look at it on YouTube or just go to the video.
One thing besides on face size, that's a good point to include, Darion, is that I had a client of mine who put money in a 401k as an individual, and then they don't realize based on face size, for example, if you're a single individual and you make over $87,000, at that point you can deduct a traditional IRA to reduce your taxable income because you're an active participant in your 401k.
Yeah.
So you got to be mindful, right, that you see that stuff on Google and TikTok, but you got to be mindful of what's your face out, your income to see if that's advice you should take as well. So I wanted to share that because I came across it recently in this past week and thought I'd just share with you guys. So why it's important to consult with professionals there.
Exactly. No, that was a great point right there. Any more questions in the chat? Does anybody else have any questions? Definitely want to. No question is considered dumb, so we definitely want to point you all in the right direction.
Darion, one question for you. I've heard people where they take trips to talk about business. Is that a write-off?
That can be. My answer is always it depends, right? And the answer that so trips and travel can be deductible. You just got to plan it out the right way, right? If you have a trip coming up and you're just going to a party, have fun. But if you're going to Miami or something for a trip and you got a business meeting on Friday and a business meeting on Monday, well, you get there Thursday, travel days don't count. Friday, you got your one business meeting or you got your conference, you go to that. And in the weekend, do whatever you want to do. And because you had to stay until Monday to go to that business meeting that you have, and then you leave on Tuesday. That trip, my friend, is deductible. Or you just go to Eventbrite, find a random business conference in Phoenix or Atlanta, anywhere around the country, and you can make that trip deductible too as well. Go sit in there for at least 4 hours a day, go to the conference, meet with a client, and then after that, take care of yourself. So yes, it can be deductible, but you got to plan those out in advance because you do get board meetings too as a business owner. I know we hear about these larger corporations going all over the world to these resorts and you see the movies and they living their best lives. But just because you have a small business, just because it's a single member LLC, doesn't mean that we're not entitled to those same deductions. So a lot of things I kind of recommend is family trips around holidays. I know Thanksgiving coming up, Christmas coming up, or plan a trip in January and just pay for it in advance this year. But yes, I can rant about that all day. But yes, trips and travel is deductible.
Cool. Awesome.
Yeah, and I guess my question with you, Tonio, would be more so on the lines. How important is having an emergency fund? And the reason why I say this is because there's a million different ways to invest your funds, your money. But I feel like one step that people skip is having that nest egg kind of put up.
Yes.
So what's your
Yes.
opinion on that? And what's the rule of thumb for building an emergency savings?
Yeah, actually, that's a good point. When it comes to talking to a financial advisor, before we invest your money, talk about Roth IRAs, any of the fun stuff I showed you, we want to have at minimum 3 months of monthly expenses saved up for you. Why? Your business might not do well. You might have a car breaks down. You might have to help your mom. Something comes up and it's important to have 3 months of expenses. You might say, Antonio, well, what's the case? Well, recently I had a client who said, Antonio, yeah, I get your point. I'll have 3 months of expenses saved up. And we opened a 401k and he had an emergency. He took money from his 401k, had to pay taxes and a 10% penalty fee. That could have been avoided if we had a simple 3 months of it saved up in your bank account. And again, you can keep that money in your savings account, high yield account, a CD, money market account. Those tools will make you more money. But yes, at minimum, 3 months of expenses. Now, let's say it's you're the breadwinner, you have kids, and you have a spouse who's not working. Maybe at that point, you want to have 6 months of monthly expense because you're the breadwinner of the family at that point. So when you're single, no kids, it's just you have 3 months of expenses. But if you're the breadwinner, there's only one person working in the family, I recommend have 6 months of expenses saved up.
Okay. Yeah, yeah. I love that perspective. And me on the personal journey too, as well, I'll share. That's one thing I had to realize too, as well, especially being in this industry. Invest, invest, invest is always the goal. But even if you want to get into real estate, like having a down payment is one thing, but also having that emergency savings for that random furnace that needs to be fixed or that leakage or that tenant that doesn't want to pay rent. Like just keep that in mind. A little off subject, but definitely make sure y'all are saving. And then make sure you reach out to one of us to just do your research and your own due diligence before you start dumping money in these other vehicles. But big picture is have your money working for you. Don't just leave it in your traditional checking account. Tonio pointed out high yield savings accounts, which is amazing. You're saving for a rental property or you're saving for any big purchase and you just leave your money in one of these accounts, you're getting 5% just by showing up. Versus if you leaving it under your bed or in a checking account, it's not growing at all. And then if you do have extra money, that's when you reach out to Antonio. My goal is to help you all save money. He's going to be the one to help you invest it. So you ask me about stocks and cryptocurrencies, all that stuff. I'm going to point you to him and he's going to tell you the best practices. But I think that's pretty much all I really had to say. Anything you want to add? Oh, got a quick question. Can I put a business loan in high yield savings? Oh, she's smart. Tony, you want to answer? Or do you want me to answer?
Go for it. I want to hear your perspective on this
Oh,
one.
let's see. So my logic is you get a loan for starters. I think that was one of the questions on this list is that loans aren't taxable income. A lot of times people get a loan, 40,000, 50,000. When I file their taxes, they got that as income, right? That is not a taxable income. If you get lucky and you got a high yield savings account with a higher interest rate than that loan, I don't see a problem with that. It's kind of rare nowadays with these higher interest rates, but Antonio, is it anything is that's possible?
No, yes. I mean, and people do that. So back in 2021,
Hmm.
I had a client who borrowed against his house. He took $100,000 out because I think at the time the rates were like 3% at that point. He
Mhm.
borrowed his money from his home. He was able to buy some investments and buy more property just because he had a lower interest rate at that point.
Mhm.
So at some point it does make sense, but it's sometimes to Darren's point, let's say you have a credit card of like 20% and you borrow against that, then it doesn't make sense for you to borrow, pay 20% if you want to earn maybe half of that at that point.
Exactly. Yep, yep, yep. And then we're gonna keep answering questions, but I'm gonna stop this recording.